Hi everyone, and welcome to Mackenzie George & Company's presentation called the Business Growth Model. This is essentially a growth model that's designed for business owners that want to achieve financial independence using business acquisitions. Goals and objectives we want to achieve. We want financial independence. That's why we're engaging in a comprehensive plan. We want financial resources for retirement and estate purposes. And if we have children, of course, we want to provide their education. For their education, an important element is business growth. One of our assumptions in this model is 10% business growth in each business per year. And an important consideration is succession planning. How do we sell these businesses at the end of the plan? The parameters we're looking at in our model, and again, this is just a truncated version of the presentation. Full presentation will be in webinar format. But important parameters in the plan, we want to have businesses that are showing 20% profit before taxes. We'll be taking back loans for 80% of the purchase price, providing equity for 20% of the purchase price, and we want the business to have cash flows to satisfy the loan requirements over a 5-year period. We want businesses that are providing $500,000 a year in revenues, and that they're easy to run. We can just put people in there and run the business, because as the business owner, you want to concentrate on strategy and marketing. And the equity in the first unit purchases the second of the second unit, purchases the second. We put equity in the first business into the second business. Basically, 20% is funded through equity and 80% is funded through the banks. We concentrate on certain financial statement analytics in our model: profitability, solvency, being able to pay our bills, sustainability. These businesses must be able to sustain themselves without financial resources from outside. We want a return on investment of 20%, and the Paller sequence of ratio analysis. When we're engaging in looking at businesses to invest in, we want to undertake ratio analysis, and have provided various ratios on the left-hand column and the parameters that we want to see on the right-hand column. So this is kind of a map. If we have ratios that fall into these numbers, then the businesses you're looking at are good candidates for investing in. A few companies, we look at their income statements. Company A has net income of $246,000 off of fees of $568. This is a good business, showing net income of up in the 40% range, so it meets our 20% criteria. Similarly, business B, showing net loss for the year of $16,000 off of sales of $247,000. But keep in mind, we have to look only at non-discretionary expenses. The management salaries of $150,000 is really discretionary. So you as the business owner can decide how much money you want to take out. When we're determining if the company meets the 20% threshold, we have to use only non-discretionary expenses. So in this case, we need to add back the $115,000. So we see then that the net income for this company B is $100,000 off of sales of $247,000. So again, we have net income in the 40% range, which is a good candidate for our model. The business growth model is essentially a 15-year model split into 3 parts: years 1 to 5, 6 to 10, and 11 to 15. We make a few assumptions. We want the businesses to grow at 10% per year. That's why you as a business owner will have to concentrate on marketing. And if you have the right business, then 10% is a very conservative growth rate, and it's easily achievable. Again, as we said, 20% for the purchase price of each business comes from equity, and the remaining 80% comes from bank financing or other financing sources. And we're assuming that the purchase price of each business, $1 per dollar of sales. So if we're wanting to buy a business that has $500,000 in sales, we're going to purchase it for $500,000. So we need to find an equity source of $100,000, financing for $400,000. And that business needs to have cash flow to be able to pay off that $400,000 within a 5-year period. So in this year 1 to 5 grid, you'll see we have revenues starting at $500,000, which go up at 10% per year. Our cost of sales of 36%, which is quite standard in food business and other professional practice businesses. And we assume M&A expenses of 36 to 38.5%, which is quite conservative. It's quite on the high range, but again, we want to be conservative with our numbers. This model assumes that the owner takes a salary of $40,000 per business per year, and in BC the income tax rate is 13.5%. So we also assume 0 receivables. It's good to have a business that has low or no receivables. So when we see net income, in year 1, 75,000 up to 99,000 in year 5. We go to the next slide, we'll see our cash flows from the net incomes. Basically, we're using all that cash to pay down the principal and the loan over a 5-year period. And we assume that each year we're going to put $20,000 into our business in order to keep it fresh and modern. So at the end of year 5, we have the business paid off, but we are in our overdraft of $19,992. And you can take a few minutes just to look at these numbers, because we just have to truncate the presentation. Year 6 to 10, business A is in its 6th year, business B is in its year 1 to 5. We have our next slide shows the cash flows, the cumulative cash flows that can be used. Keep in mind that now in year 6 we have our first business paid off, so we're getting net income and cash flows from 2 businesses, but we're really financing the loan of only 1 business. We've taken $100,000 of business A to purchase business B, and we're using business A as leverage to get a loan for $400,000 for business B. So cumulative net income in year 6, $181,845, and we use those monies to pay down principal, or loan number 2, the principal on that. Loan number 2 is the $400,000, loan number 1 is the $100,000. We have to pay the interest on each loan, but now we have an additional assumption that we're going to put an assistant manager in to operate business A. Again, as the business owner, you want to concentrate on marketing of the company, so we put a good assistant manager in there to run the operation. As well, capital improvements, we want to put $20,000 into each business to keep it modern, keep it competitive. At the end of year 10, we have ending cash of $385,449, and then we add business C in years 11 to 15. Again, we're going through the same process of using $100,000 equity, $400,000 bank financing. You'll see as the numbers go that years 1 to 5 are really the years where you really have to watch your money, but the intent in years 1 to 5 is to gain that equity in that first business, and then we can use that equity to leverage business growth in years 6 to 15. So cumulative cash flow from the 3 businesses in years 11, 326, 892, which is again used to finance the 2 loans, as well as capital improvements in all 3 businesses. Now in year 11 we have an assistant manager in each of the businesses, but still look at our ending cash. At the end of year 15 we have just about $1.5 million in cash, because you've engaged in a good, solid, comprehensive business model. So what do we have at year 15? $1.45 million in the bank. An annual salary for the owner of $120,000. Again, we said previously that the business owner takes $40,000 per business per year. You have an assistant manager secured at each location. Assuming the market value equals the revenues, in year 15, the 3 businesses cumulatively did revenues of $2.373 million. So if we're assuming a market value equal to revenues, you now have $2.373 million in assets that you can sell, which provides a really good estate resource. Net income up to $500,000 is taxed at the small business limit of 13.5% in BC, and any amount in addition to that is taxed at the general rate of 38%, but we've already incorporated that additional tax rate in our numbers. As the business owner, you want to concentrate on management, marketing, and strategy. So strategy of the company, you want to make sure that over the 15-year period you're keeping to your numbers and you're able to incorporate a good marketing plan that will facilitate 10% growth per year in each business. Graphically speaking, look in years 1 to 5, there's no real change in the net income. That's because basically no real change in cash, because all the cash is going to pay off the loan, but things really start to take off in years 6 to 15. And then look at year 15, your revenues are just above $2.25 million, your net income is strong, and your cash balance is really high, which is what we're looking for in a plan. To summarize, the growth model analytics are again what we've already spoken about, including the 20% net income requirement, $500,000 revenue level. Preferably you want a recession-proof industry, because especially in food businesses or professional practice industries such as dentists or medical, people need these services and these products. Final thoughts, we provide some other seminars such as Business Audit Proof, how to effectively secure your business from theft, which will increase the effectiveness and efficiency of your operation. Business valuation, how do you value a business to purchase, to incorporate into the business growth model? And financial statement analysis, we drill down a little further into how to analyze the financial statements of a company, again using these ratios. And corporate tax planning, how to keep as much as you can through efficient tax planning. So thank you for joining us. We'll look to hear from you soon. We have other seminars on our website and on our Facebook page, so just enjoy them while you can. Thank you. Bye-bye.